How do I know if it's a reversal or if it's a continuation? How can I determine the directional bias? These are two of the most common questions that I get asked from my students. So in today's video, I'm going to explain how we can anticipate a continuation or a reversal and how we can use DRT to determine directional bias. Now, I went over a type 1 dealing range in the last lesson. You can check that up here somewhere. But if you haven't, that's fine, because I'm going to recap that over here. Now, I'm going to explain everything conceptually first, and later on I'm going to get into some chart examples. So here we have two levels on our screen in front of you. This level is our buy-side liquidity pool above an old high, and down here we have our sell-side liquidity pool, which will rest below an old low. Now, in this example, we're going to discuss a bearish type 1 dealing range. And in order to establish a dealing range, we must see two conditions met. The first condition is we want to see price raid buy-side liquidity above an old high. We then want to see the market reverse and drop lower, sweeping liquidity below an old low. When a swing low forms after this, this gives us our new dealing range from our high down to our dealing range low. Now, since we are here on a higher time frame bearish trend, we ideally want to see lower prices. And for a type 1 dealing range, we expect a continuation profile. So for this specific type of dealing range, we're using it as a framework to hunt for short setups. Now, let's get a little bit deeper here. Between the highest point of our dealing range, so our dealing range high, and the lowest point of our dealing range before the swing formed, so our dealing range low, we have the equilibrium price point, or the 50 DRT level. Since the dealing range high is the highest price inside of the range, and the dealing range low is the lowest price inside our range, the equilibrium or 50 DRT level will be the fair price, since it sits halfway between the highest price and the lowest price. Now, price will generally gravitate back towards equilibrium, since this is fair value. And the market has been coded on this principle of offering fair value. Now, inside of this dealing range, anything above the equilibrium or 50 DRT level, we can consider that as a premium market. And anything below that equilibrium or 50 DRT level, we can consider that as a discount market. For ideal entries, when we are looking to go short and to use a type 1 dealing range as a framework, we ideally want to see the market reprice up to a premium, since we always want to short premium prices and we always want to buy discount prices. Now, let's get a little bit deeper here. Inside of a premium market, we can also divide this into two sections, where we have a midpoint between the dealing range high and the equilibrium level. We call this the 25 DRT, since we are in a type 1 bearish dealing range. We can also do the same in a discount market, where we have the mid price between the dealing range low and the 50% equilibrium, or 75% of this entire dealing range, and we call this the 75 DRT level. The upper quadrant of this dealing range, between the 25 DRT and the dealing range high, we can class this as an extreme premium. And anything between the 75 DRT level and the dealing range low, we can class this as an extreme discount. Now, the market can gyrate inside of these levels, and typically this will be seen inside of a consolidation market, where we'll see the market reprice to an extreme premium, turn around and gravitate back towards equilibrium, and or an extreme discount. We will then see the market run higher into an extreme premium, where if we are bearish, we will ideally look for short setups here, and then we'll see the market reprice back down to an extreme discount, hunting the highs and lows as it bounces between an extreme premium and an extreme discount. But I'll get into that a little later. Now, there's going to be several factors which will prevent price reaching above equilibrium into a premium market. Generally, it will rely on our 75 DRT level and the PD arrays that we can see in price action. Now again, this is way beyond the scope of this presentation because I'm really trying my best to keep things as simple as I can here. But it will rely on low resistance versus high resistance liquidity run conditions, the type of news drivers that we have present in the market, and of course the volatility of market conditions. Sometimes the market will be very heavy and it won't give us an opportunity to get to a premium, and we'll see the market roll over, keying off some kind of inefficiency or a PD array to the left. Now I will show you examples in future lessons, but for now let me give you an example here of a bullish type 1 dealing range. Now again, we have the dealing range high and the dealing range low. The caveat to this is we want to see a sell side liquidity pool rated first, forming the dealing range low, and then we want to see a buy side liquidity pool rated above an old swing high, forming our dealing range high. Again, we have to have a bullish higher time frame dealing range, and I will get onto that and hopefully do a whole video just on how we can interpret directional bias and where the market is likely to reprice to. So if you want me to do that, please subscribe and leave a comment below, because that will be nice, and I'll continue to make more of these videos, right? So in a type 1 bullish dealing range, we again anticipate the market to drop into equilibrium or below and find something to the left that we can use as an entry to key off to send price higher back above the dealing range high. Now, let's get again a little bit more deeper. Let's talk about a type 2 dealing range, and in this example I'm going to use a bullish dealing range. So we have the higher time frame, which is bullish. A type 2 dealing range is going to be a reversal profile. Now, why I really like the type 2 dealing range is because even if you cannot establish if we're in a bullish or a bearish climate, the distinct feature of a type 2 dealing range is that we will have clear, discernible equal highs or equal lows. In this case, since we are bullish, we will have clear, equal highs above the market. The market will travel lower, below equilibrium, and it will raid some kind of a liquidity pool and or rebalance an inefficiency to the left of the market. And yes, we can predict to a very high degree of accuracy when this turning point will occur before price even reaches this level. And again, that's beyond the scope of this presentation. But this here is enough information for us. Once we see price turn around here, ideally what we're looking for is a change in state of delivery around this. And again, I'll get into that at some point. But in this case, whether the higher time frame is bullish or bearish, the draw on liquidity is going to be above these equal highs. So this gives us a directional bias for price to run higher. Even if we run those highs and price continues lower with the higher time frame bearish bias, it still gives us room to work with where we can hunt for setups to go long. If you are familiar with algorithmic price action and ICT concepts, think market maker buy model. Now, these DRT levels, together with the dealing range high, the dealing range low, and our equilibrium level, this sets the framework for the algorithm to move price within. All your high probability PD arrays, your high probability gaps, order blocks, breakers, whatever you want to call them, they are all subordinate to this. High probability PD arrays will be printed based on these DRT levels. Furthermore, we can also use these DRT levels to gauge algorithmic order flow. For example, if we see price close and displace through one of these DRT levels, like the 25 or the 50 DRT, then this is exactly what we want to see. Now, as a bonus tip here, if we were to buy this market, we would only buy from equilibrium and below. And I'll show you an example of why this is very important. Our initial target would be the dealing range high and or an inefficiency that sits above the market. Now again, I'm trying my best to not get so detailed with this, but let's jump into a chart example. This took me a long time to do because I had several variations. And one of the criticisms I get is that I overcomplicate things sometimes, and I've been doing this for nearly 8 years, so I'm trying to look from the perspective of somebody who is fairly new to these concepts. So bear with me, because what I'm about to show you is something that I've been using for the last few years, and every high probability setup that I take is based on the concepts that I'm about to show you today, and it all revolves around DRT, or dealing range theory. So let me give you an example here of a type 2 bullish dealing range. We have seen the market travel lower, and it swept below an old low to the left. I will show you that low in a second. Now, straight away, our eyes should be going to the equal highs. So whether we're bullish or whether we're bearish on the higher time frame, we are bullish, but I will explain why in the next few slides. The first thing we can note that not only have we swept the liquidity below this swing low, we also have an old low to the left, and we've really seen price dig inside of that liquidity over here. So looking at just this chart alone, we can see that the damage has been done to sell side. Above the market, we can clearly see we have equal highs. We also have a whole pool of relative equal highs above the market, and we can see clear inefficiencies above those highs. So we have a fair few targets to aim for the upside, right? Since we have swept above these old highs to the left, and we have raided the sell side liquidity pools below the market, we now have a new dealing range from the equal highs down to our newly formed low. I want to bring your attention to this down close candle over here. This is a very important candle. This is a high probability order block, and I'm going to explain why for several reasons. More importantly, this order block has closed below all of that liquidity to the left. Now, watch what happens. When we plot our DRT levels from our dealing range high down to our dealing range low, I want you to note the 25 DRT level over here. Notice we have a fair value gap here that overlaps that 25 DRT level. Also note the consequent encroachment, which is that black line. This is our inversion fair value gap, because inside of the swing that raided the sell side liquidity, that sell side imbalance becomes our high probability inversion fair value gap. You can see the support that we've had at the discount low. When price closes above it like we do here, this is something that I refer to as an early change in state of delivery. Think of it as a price action event that triggers the algorithm to say that we are done offering sell side delivery. We want to switch gears over here and start a buy program offering buy side delivery to where we're going to see areas of equal highs and inefficiencies above the market. Remember, they are the two primary objectives that the algorithm will seek to reprice to. Also take note here at the 50 DRT level, or our equilibrium. Note the bodies here. That is not buying and selling pressure. That is price programmed to stay at that level and not go below it, since the volume is contained inside of the candle's bodies. We wick through it into an imbalance. We have sell side imbalance here, which runs back through with buy side delivery. So we have a balanced price range. We do not need the market to reprice lower. In this case, we have two entries. We have this imbalance that sits around that equilibrium level, and we have the inversion fair value gap that sits at that 25 DRT level. We then see price clearly run higher. Note how it runs through that 75 DRT level with a close, leaving an inefficiency in the form of a fair value gap, which we see traded to on the next candle before it runs for that buy side liquidity above the equal highs, like we can see over here. Again, note the consequent encroachment of that fair value gap overlapping with that 75 DRT level. There is a whole lot of other stuff I can talk about here, but again, for now, let's keep it simple. Now, how do we know that we're going to continue inside of a buy program? How do we know that the higher time frame bias is bullish for this particular market? Well, let's zoom out a little bit, and here you can see where we have our old low that we raided below. And what can we clearly see above the market? Equal highs, right? So again, we can clearly see on this chart that we have done the damage below the lows. All of these lows have been raided. What's left is all the buy side liquidity above the highs, right? So the market is going to reprice higher. It is inside of a buy program. When we're looking for higher prices, we can use a type 1 dealing range inside of a type 2 dealing range once we understand the directional bias. And again, I'll show you examples of that. But for now, we have now established that we have our equal highs, which will be our parent dealing range. Now we will have major buy side liquidity above those highs. And we have our dealing range low, where we'll have major sell side liquidity that rests below that. We can also see minor buy side, let me move this way. We can also see our minor buy side liquidity pools and our minor sell side liquidity pools, since this is a minor dealing range inside of the parent dealing range. I was going to call it a child dealing range, but I felt that was a bit weird. Anyway, this establishes a new dealing range. So we can now plot our DRT levels and our equilibrium price point. It's interesting to note here, look where we had that smaller dealing range inside of the larger dealing range and where those equal highs formed at equilibrium. Also look at where we had the support here at that 50 DRT level, which also overlapped with our 25 DRT level here on our parent dealing range. DRT is the algorithmic structure of the market, and there's a pricing sequence that runs from higher time frame down to lower time frame. What we're seeing here with the equal highs run lower is the exact same thing that we're seeing here inside of the lower half of that parent dealing range. What we're seeing over here in the lower quarter of that parent dealing range is the exact same thing that we're seeing from this dealing range and from the dealing range up there. Now that's one for your studies. Let me bring your attention to the dealing range low and our newly formed minor dealing range inside of our parent dealing range, since we have raided those equal highs here, right? This gives us a new dealing range. I'll just dim out the parent dealing range. So you can see we have the dealing range low and the dealing range high with our new plotted DRT levels. Now, note what happens. We have raided sell side below this low, buy side above this high, giving us a new dealing range, but we have a clear draw on liquidity in the form of the equal highs above the market. So here we have a type 1 dealing range inside of a type 2 dealing range. And what do we anticipate price to do? We anticipate to drop back lower into equilibrium and below. So we ideally want to see price drop into a discount relative to this dealing range, which is a smaller fractal of the larger dealing range. Now, what level does it come into? Remember what we did over here. That last down close candle over here, which left the inversion fair value gap. That is a very high probability inversion fair value gap. My eyes look at this 50 DRT level and I go straight across to the last range that was formed. The last sell side imbalance that formed inside of that swing is going to be our high probability inversion fair value gap. When it overlaps with a DRT level, especially around equilibrium, this is going to be a very sensitive price point. I mean, you can see how many times we have tapped into this level. That is how you determine where your high probability inefficiencies lie, where your high probability inversion fair value gaps lie, where your high probability order blocks lie. Now, let me get back to that order block in a second. Notice that we haven't yet traded into that order block. Well, let's see what happens. Price now runs higher towards those relative equal highs. You can see how we have ran straight through the 75 DRT level. Now, another thing that causes a lot of confusion is the timing of when this happens. All of this area here is something known as time distortion, and is where the algorithm holds price to engineer liquidity. Again, beyond the scope of this presentation, but this is what tends to catch people out because they're trying to trade inside of this range up and down. Time comes before price, but DRT with time, with high probability PD arrays, you suddenly get an X-ray view. It's like reading the matrix. Anyway, Let's keep things clean and let's move along. As you can see here, just before we raid that major buy-side liquidity pool, and this is very typical of when we come to the extremes of dealing ranges, is we will see in that upper quadrant, price will accumulate, engineering buy-side liquidity above the market. Now, why is that? Because over here, retail are placing their stops. They look at those equal highs as double tops, right? And now what do the books teach us? They teach us to place our stops above double tops because that's strong resistance, right? So when the market reprices all the way back to those levels, it will consolidate below it, giving retail a false sense of security. And they will then be piling in short positions because they're like, look, it's a double top. So that is strong resistance. And look, price is unable to get above it. Well, obviously the algorithm has other ideas. It sweeps above it once, reprices lower into where? You see the inefficiency at the 75 DRT level, and then really runs higher. What does it leave? Relative equal highs. And then we see price really reprice lower. All of these equal lows down here, we have a lot of sell side liquidity below the market and this inefficiency. The market is going to reprice lower back into the inefficiency, and remember our old order block. Look at the price action here with the bodies. It's probably a little small, so I might try to zoom in on this part. We find a lot of support over here, and then we see price run higher. Look at the reaction that we've had from the order block. 25 DRT level, we find support. 50 DRT level, we find support. Now this is the reason why I say it's best practice to not enter above that 50 DRT level into a premium. Because when we get to the extremes of the dealing range, especially in the upper quadrant, we're doing the same thing before we run that buy side liquidity above our parent dealing range high. Now, of course, we've run above it once, but retail is still going to look at that area as strong resistance. And so they will engineer liquidity back above those equal highs. Price will drop lower back into our 50 DRT level and below. Note the order block that we have at 50 DRT. The order block at 50 DRT is a very powerful order block. Any order blocks that sit above the 50 DRT level, they're weaker order blocks. Notice how we have all of these order blocks here, and price just really runs all the way through them because we have still a ton of sell side liquidity in the form of retail trend lines below the market. Now, this is an example on euro dollar on the hourly time frame. What transpires next is the market runs higher and we can actually predict the high of this whole buy side program. This is something that I've kept close to my chest for quite a number of years. And it's the culmination of almost 8 years of algorithmic study and deep study on ICT concepts. In the next lesson, I'm going to walk you through the entire range of the euro dollar and how I was able to predict where price would go 1 year before during the 2024 mentorship right here on this YouTube channel. I'll link somewhere up there. As you can see, it's not just about premium and discount. It's not just about sweeping a candle high or a candle low. To get ridiculous precision and an understanding of where the markets are going and how the algorithm is using these DRT levels to set a framework really is the core to algorithmic based price action. Now, if you haven't done so already, click the link below to download my free ebook, Market Maker Secrets, where I give you the foundation to algorithmic price action. And if you like what you see here and you'd like me to continue making these videos for free, again, please like and subscribe. Leave a comment on what you want me to teach next, and I'll catch you soon. I wish I had this when I was coming up.